In this video, I'll be covering the 5 C's of your credit rating and why they are so important to get that mortgage approval. Hi, I'm Jimmy Brockett with Oakwyn Realty and welcome to the Inside Track, where I bring you the answers to the questions you didn't even know you had about real estate. Before we get going today, if this is your first time here or you haven't done so already, please hit subscribe, switch on the little bell so you can get notifications each time I do one of these videos. Buying your first home is an incredible step in life, but it's not without its hurdles. One of which is demonstrating you are credit worthy, which all comes down to your credit rating. This is how lenders and credit agencies determine the interest rate you pay or whether you will qualify for a mortgage at all. As mortgage rules continue to change, the credit rating is becoming even more important, as higher credit ratings could mean a lower interest rate and save you thousands of dollars over the life of your mortgage. If you've never given much thought to your credit rating before, don't worry, it's not too late. I'll take you through everything you need to know. The most important part is in which, in order to qualify for a home, you must have a credit rating of at least 680 or more. There are several attributes that factor into your credit score, and these are commonly referred to as the 5 C's and consist of character, capacity, capital, collateral, and conditions. Let's take a look at each one. Okay, number 1, character. The character component of your credit score is essentially based on you and your personal habits, which comes down to whether or not it's in your nature to pay your debts on time. Some of the components that make up this portion of your credit score viability include the following: whether you habitually pay your bills on time, whether you have any delinquent accounts, how you use your available credit, and I'll give you a little quick tip: using all or most of your available credit is not advised. It's better to increase your credit limit versus utilizing more than 70% of what's available each month. For instance, if you have a limit of $1,000 on your credit card, you should never go over $700. If you need to increase your score faster, a good place to start is using less than 30% of your credit limit. If you need to use more, pay off your credit cards early so you don't have to go above that 30% of your credit limit. Number 2, capacity. The second component relating to your credit rating is your capacity. This refers to the ability to pay back the loan and factors in your cash flow versus your debt outstanding, as well as your employment history. How long have you been with your current employer? Or if you are self-employed, and for how long? Don't be confused, as capacity is not what you think you can afford, it's what the lender thinks you can afford depending on your debt service ratio. This ratio is used by lenders to take your total monthly debt payments divided by your gross monthly income to determine whether or not you are able to pay back the loan. Number 3, capital. Capital is the amount of money that the borrower puts towards a potential loan. In the case of mortgages, the starting capital is your down payment. A larger contribution often results in a better rate and in some cases better mortgage terms. For instance, a mortgage with a down payment of 20% or more does not require default insurance, which is an added cost. When considering this component, it's a good idea to take a look at how much you have saved and whether your down payment funds will be coming from things like a savings account or an RRSPs, or maybe it's a gift from an immediate family member. Number 4, collateral. Collateral is something that is placed against a loan for security of repayment. In the case of auto loans, the loan is typically secured against the vehicle itself, as the vehicle would be repossessed and resold in the event that the loan is defaulted on. In the case of mortgages, lenders typically consider the value of the property you are purchasing and other assets. They want to see a positive net worth. A negative net worth may result in being denied for a mortgage. Overall, loans with collateral backings are typically more secure and generally result in lower interest rates and better terms. And number 5, conditions. The conditions of the loan can also influence the lender's desire to provide financing. Conditions include the interest rate, the terms, the length of the loan, and the amount of principal needed. Typically, lenders are more likely to approve specific loans, such as car loans or home improvement loans or mortgages, as these have a specific purpose as opposed to a signature loan. There is no better time than right now to recognize the importance of your credit score and check that you are on the right track with the 5 C's on your debt habits. A misstep in any of these could be detrimental in your efforts of getting a mortgage. So there you have it, the 5 C's of your credit rating. Let me cover them: character, capacity, capital, collateral, and conditions. If today's video led to more questions, or if you'd like to know more about your credit score and how you would qualify, please don't hesitate to reach out so I can put you in touch with one of the best mortgage brokers this side of Canada, Maureen Young. As always, I'm loving all the questions, comments and feedback and ideas of subjects for me to cover. So if you've got something, please post it in the comments below. And as always, thanks for watching.